Howdy, Jacob here. Today we're looking at company Ashland in the chemicals industry, 5 billion market cap on 5.9 billion enterprise value. Growth is actually hugely negative from 10 years ago, but relatively flat over the last 6 or 7 years. Let's look if there must have been a devastation there in 2014, 2015. Okay, yep, we are seeing that. So it looks like they sold off part of their business. Big reason for why we're seeing huge revenue declines there. But again, like I said, relatively flat over the last 6, 7 years. Low return on invested capital, gross margin 30%, relatively decent. Operating margin in the high single digits, so it has been improving. Looks like they're selling off their parts of their business that hit the top line, but not necessarily the bottom line. And dividend per share, they've consistently paid a dividend, but it's been kind of all over the place. I mean, between 95 cents and $1.56 all over the place, but hasn't been like, a slow increase year over year. And it is quite a bit lower in the earnings per share, so that's a positive sign. Balance sheet shows 417 million cash on hand with 1.3 billion long-term debt, just 16 million short-term debt. But that 1.3 billion long-term debt in relation to their free cash flow on a 5-year average basis, you're looking at maybe 100 million. So it is quite a bit. Looking at about 13 years of their 5-year average free cash flow. So a lot of debt here. And it has been reduced quite a bit. So it looks like when they sold off parts of their business, maybe they helped increase that debt pay down. But still, they do have quite a bit of debt remaining under their long-term debt on their balance sheet. And with a hefty amount of their free cash flow and selling off of businesses, or parts of their business, I should say, they are buying back quite a bit of shares. So it looks like a little bit net acquisition here in 2021 at $295 million, but and 662 million acquisition in 2017. Outside of that, too, though, those two acquisitions, you're really looking at debt reduction and share repurchases, as well as this dividend that also pays out 79 million. Okay, so it looks like they've just sold off parts of their business to fund these other ventures. So this will be an uh, interesting projection here. So let's look at it. Let's get to it. Revenue, I'll say low growth, to maybe 10 on the P, price to free cash flow, just because one, I want to base it off of their enterprise value, and two, I just don't think at the end of 7 years there'll really be any growth here. I'll really just go roughly in line with averages here. Maybe let's do a wider range, 8, 6. And for share change, 1% would be 50 million, 67 to offset stock-based compensation. But again, their 5-year free cash flow is only about 100 million. So they can't afford that. I mean, even if we're generous and say it's 200 million, they're already using 35% of that free cash flow to go towards dividends. So it really only leaves 100 million to give even just 30 million to their debt reduction. And so here, I'm going to be pretty conservative on these share repurchases. Say that, maybe they buy back 1% because that'd be about 67 million in aggregate, 79 million for dividend, leaving roughly a third of their free cash flow, if we're being generous, to debt reduction. So I think I'm comfortable with that. Dividend, let's not increase it. Let's just keep it at $1.44. I think I'm comfortable with that. And it's just not pretty. I mean, not a huge surprise here. I mean, they're really just selling off parts of their assets to be able to fund some of these things. So if you just look at the numbers, you would say, oh, they're buying back 3 to 4% of their shares a year. They're paying a dividend that is a 1.6% yield. So you're looking at that saying, hey, that's like 5 to 7% free cash flow right there, going straight to the stock shareholder. But again, you have to look, sold off 1.6 billion here, sold off 985 million here. So that's not, you have to put that into your assumption setting, saying that those devastations are really going to hinder their revenue growth and very likely going to tap into the bottom line as well. So I think I'm comfortable with these assumptions, and it's not looking pretty here. So definitely not one that I'm going to be getting into anytime soon, but I hope you enjoy the video. Have a great rest of your day.